Hi everyone, welcome to GrowthMark. We're here to blend our extensive knowledge in banking, finance, accounting, and real estate to guide you through your financial journey. Today, we're focusing on a critical aspect of personal finance, building a great credit score. Before diving into the mechanics of credit scores, let's take a brief look at their history in the U.S. The concept of the credit score was created in the 1950s by engineer Bill Fair and mathematician Earl Isaac, who founded Fair Isaac Corporation FICO. Their goal was to create a standardized, objective way to evaluate a borrower's credit risk. This was a significant shift from the previously subjective methods used by lenders, which often led to inconsistent and biased lending decisions. The FICO score, introduced in 1989, revolutionized lending, making it more fair and accessible. It democratized credit, allowing more people to borrow money for homes, cars, and other major purchases based on their creditworthiness, rather than their connections or background. This innovative approach to credit evaluation has had a profound impact. According to the Consumer Financial Protection Bureau, more than 1/4 of the U.S. population has subprime credit scores below 620. This significantly affects their financial opportunities, often resulting in higher interest rates for loans and credit products, limited access to quality housing, difficulties in renting a property, and sometimes even influencing how they are treated by others, including employment opportunities. In contrast, people with supreme score above 720 enjoy all the benefits. Your credit score is a vital part of your financial identity, acting as a reflection of your financial discipline and habits. A solid credit score can unlock numerous benefits, from lower interest rates on loans and credit cards to favorable terms from lenders, all contributing significantly to your financial well-being. The journey of understanding and improving your credit score begins with knowing what it constitutes. A credit score isn't just a number pulled out of thin air. It's calculated based on key components derived from your financial activities, which are reported by credit bureaus. These components include your payment history, credit utilization, the length of your credit history, new credit inquiries, and the variety of credit types you manage. Each of these components plays a distinct role in assessing your creditworthiness and determining your overall credit score. Let's start with the most influential factor, your payment history. Accounting for 35% of your credit score, this aspect underscores the importance of making regular, on-time payments. It's the clearest indicator to lenders of how reliably you handle debt. Ensuring on-time payments, whether by setting up automatic transactions for your recurring bills or by diligently keeping track of due dates, can significantly bolster this aspect of your credit score. Moving on to credit utilization, which makes up 30% of your score. This ratio measures how much of your available credit you're using. It's advisable to keep this ratio under 30%. By managing your credit card balances and avoiding maxing out your limits, you present yourself as a responsible borrower. This involves strategies like paying off balances in full each month, requesting credit limit increases without ramping up your spending, and distributing your expenditures across various credit accounts. Another key factor is the length of your credit history, contributing 15% to your credit score. A longer credit history generally paints a picture of financial stability. Keeping old credit accounts open, as long as they're not costing you in fees, and avoiding opening several new accounts in a short period can help in maintaining a healthy credit age. The impact of new credit on your score is also crucial, accounting for 10% of your overall credit rating. Every time you apply for credit, it can temporarily reduce your score due to hard inquiries. Remember, hard inquiries stay on your credit report for 2 years. To mitigate this, it's essential to be strategic about when and why you apply for new credit. Space out your credit applications and approach new credit opportunities with a clear purpose, ensuring they align with your overall financial goals. Diversifying your credit mix can also have a positive impact on your score, contributing to 10% of your overall credit rating. Having a blend of different credit types, like credit cards, personal loans, and mortgages, demonstrates your ability to handle various forms of debt. However, it's important to pursue this diversity naturally over time, taking on new credit only as it suits your financial circumstances. Here's an extra tip for you. If you're considering a large cash purchase, such as buying a car, it might be more beneficial for your credit score to opt for financing instead. You could take out a loan for the purchase and then pay it off in full within a few months. This strategy demonstrates to lenders your financial health and can provide a boost to your credit score. It's a way of showing that you can handle larger credits responsibly, further enhancing your creditworthiness. In addition to these primary factors, regular monitoring of your credit reports for inaccuracies and understanding the implications of actions like co-signing or managing joint accounts are essential practices. Staying informed about changes in credit scoring methodologies also keeps you a step ahead in managing your credit health effectively. A real-life example can illustrate the impact of these strategies. Consider John, who faced the challenge of rebuilding his credit following a bankruptcy that severely affected his score, which had dropped to 500. He came up with a plan to not just rebuild but maximize his credit score strategically. Recognizing the importance of building a solid credit foundation, John began by obtaining a secured credit card with a modest deposit, setting his initial credit limit. This secured card allowed him to start with a secure financial footing. John was strategic about when to apply for credit cards. After responsibly using his secured card for about 6 months and seeing a significant improvement in his score to 620, he applied for a second credit card, this time an unsecured one with a lower credit limit. This allowed him to gradually expand his credit profile without risking too many hard inquiries at once. He used both credit cards judiciously for necessary expenses, ensuring he never exceeded 30% of their credit limits. By maintaining a low credit utilization ratio on each card, he demonstrated responsible credit card management. To establish a flawless payment history, John set up automatic payments for both credit cards to clear the full balances each month. This ensured that he never missed a payment, positively impacting his payment history. After consistently managing his credit cards for about a year, with his score at 670, John requested credit limit increases on both cards. These increases helped lower his credit utilization ratio further and demonstrated responsible credit usage. With his credit cards in good standing, John explored other credit types. He took out a small credit builder loan, which introduced installment credit into his mix, and over time, he reached a score over 720. Additionally, John adopted a strategic approach for significant cash purchases, like buying a car. Instead of depleting his savings, he opted for financing, taking out a manageable auto loan and paying it off quickly. This showcased his ability to handle larger credits responsibly. As his credit continued to improve, John began planning for a mortgage. He knew that maintaining his responsible credit habits was crucial and carefully monitored his credit reports for inaccuracies. When his score reached 810, he applied for a mortgage and secured a favorable interest rate, thanks to his excellent credit history. Throughout his journey, John continued to regularly monitor his credit reports for inaccuracies and discrepancies, promptly disputing any discrepancies to maintain the accuracy of his credit history. John's example demonstrates that rebuilding a credit score, even from a low point, is achievable with disciplined financial management, strategic credit use, and patience. It underscores the fact that each step taken toward managing your credit effectively can have a profound impact on your overall financial health. Here are the key points for you to remember and follow. 1. Prioritize on-time payments. Ensure you make all payments on time, as your payment history significantly impacts your credit score. 2. Manage credit utilization. Keep your credit card balances below 30% of your credit limit to demonstrate responsible credit usage. 3. Maintain a longer credit history. A longer credit history indicates financial stability, so keep old accounts open and avoid opening too many new ones in a short period. 4. Be strategic with new credit. Minimize new credit inquiries by applying for credit strategically and aligning them with your financial goals. 5. Diversify your credit mix. Having different types of credit can positively affect your score, so naturally add variety over time as it fits your financial situation. And there you have it, folks. An in-depth exploration into building a great credit score. If you found this guide helpful, please like and subscribe for more valuable content. We're eager to hear from you. How are you planning to implement these strategies in your credit journey? Share your experiences and insights in the comments below. Your contributions could be the key to helping others navigate their path to financial stability.